Good morning. I'm Florbela Yates, and I'm the MD at Equilibrium Investment Management. We are the group's discretionary fund manager and retail multi-manager. So unlike Curate, which is a single asset manager, we construct diversified portfolios made up of multiple underlying managers who have a trusted track record of managing assets in specific asset classes. As an established investment business today, we are going to try and give you some insights into how we manage clients' assets on behalf of our financial advisor partners. As a business, we've been around for 17 years, and we are a global business with a team spread amongst our offices in Johannesburg, Pretoria, and Cape Town in South Africa, and in London and Manchester in the United Kingdom. And our assets under management at the end of June 2025 were 32 billion rand, and our global team currently manages approximately 16 billion rand on behalf of South African retail investors. As a combined team, we cover over 1,000 local funds and 20,000 offshore funds. At Equilibrium, we believe strongly in the value of advice, and so we follow a partnership model with advisors. We spent a lot of time with our advisor partners understanding the outcomes that they are trying to solve for clients, and then constructed portfolios to specifically address those needs. We follow an outcomes-based investment philosophy where we consider the appropriate investment horizon for each portfolio, an appropriate risk budget, and then determine the appropriate outcome or benchmark that can be achieved with a high level of probability. Rather than using an arbitrary peer benchmark, we target outcomes that advisors are trying to solve for, ranging from income drawdowns to real returns. Although the Johannesburg Stock Exchange is the largest exchange in Africa, it only represents 0.4% of the global investment universe in terms of market capitalization and number of stocks. So if you invest in South Africa, you're actually missing out on 99.6% of the global opportunity set. Truly diversified portfolios need to have exposure to asset managers across the entire globe, in both developed and emerging markets. Whilst many traditional portfolios are constructed using a portfolio with a static 60% in equities and 40% in bonds, we construct robust portfolios that are designed to perform through the cycle. We start by calculating the optimal strategic asset allocation that has the highest probability of getting us to our investment outcomes. This entails deciding on what amount we need in each asset class in order to achieve our objectives. This gets us about 70% of the way. Within each asset class, we start with a passive allocation. Then we extend the opportunity set by looking at which asset classes are best suited to other strategies, such as smart beta or active managers. This further increases our probability of getting to the outcome. Then, once we've decided on the appropriate strategy, we allocate an appropriate manager or fund to execute on that strategy. And whether we do use a group-managed fund, such as a Curate fund, they are there on merit entirely. They would have gone through the same due diligence process as any third-party manager. We then regularly review the portfolios, make tactical asset allocation tilts, and ensure that the managers are sticking to their mandates in order to ensure that the portfolios continue to meet our investment objectives within the prescribed risk objective. Our offshore office was established prior to Equilibrium's existence, initially to manage assets for the First Rand Group and some big institutional clients. Over the past 27 years, the business has grown substantially and now manages almost 7 billion rand in assets across a wide range of portfolios for both retail and institutional clients around the globe, with capabilities across listed assets as well as private markets. We are one global team, following the same philosophy, and members of both teams attend joint asset allocation meetings and various local and offshore manager research meetings. But the primary responsibility for our global retail portfolios rests with the UK-based team. Having a team based abroad makes it a lot easier to do due diligence on managers on site, attend investor and analyst meetings, and global conferences. And their expertise has been recognized through various industry awards. Our range of global models has been designed to outperform a basket of currencies made up of US dollars, pounds sterling, euros, and yen over appropriate time horizons and within specified risk budgets. The Equilibrium Global Cautious Portfolio aims to outperform this global cash bucket by 2.5% over rolling 3-year periods, whilst not losing more than 7% over any rolling 12 months. That's from January to January, February to February, and so forth. The Equilibrium Global Managed aims to outperform global cash by 4% over rolling 5-year periods, without losing more than 12% over any given year. And the Equilibrium Global Growth Portfolio aims to outperform global cash by 5.5% over rolling 7-year periods, whilst not losing more than 19% in any given 12-month period. By looking at the outcomes together with potential drawdown targets, advisors can easily identify the portfolio that is most suitable to their clients. And these portfolios are available for both asset swap, using the Momentum Wealth local portfolio, as well as hard currency offshore investments through Momentum Wealth International for clients who've already externalized their cash. As mentioned earlier, we believe in strategic asset allocation and therefore use a building block approach, whereby we build diversified asset class building blocks. So you will notice that we use the same managers across all 3 portfolios, but the allocation to each differs in line with the risk parameters for each portfolio. The portfolios are fully diversified, utilizing a combination of managers from around the globe, covering both emerging and developed markets. You'll notice that there's a sizable allocation to the Momentum Global Equity Fund. This is a flagship multi-managed portfolio, which Richard will go through in a little bit more detail. But I just want to mention briefly here that it gives investors exposure to 11 underlying specialist managers for the low fee of only 54 basis points. And now I'm going to hand over to Richard Stuckey again to talk you through which equity managers we use in the Momentum Global Equity Fund. Richard, over to you.
Okay, one of the things I hope you associate with us is a differentiated lineup of managers, guys you've never heard of, the likes of Lyrical, Rainier, Granahan, Moran Wright's in there as well. I'm hoping these aren't the kind of standard names you hear all the time. The other thing you'll have heard us say again and again and again, it keeps going on, is about having a blend of investment styles. We think that is super important. Why do we think it's so important? It isn't just to add names to the roster. There are 2,500 stocks in MSCI AC World. That's the index we're typically trying to beat. I want to know everything about every one of those 2,500 stocks. That's the first reason you're going to need a lot of managers, I think, because there's a lot of stocks. Very simple. Second reason, a good investment is about what you get. Let's put that over here. What is that? That's profits. We know that. It's also what you pay for it over here. Now, if you only invest in companies that make lots and lots of profits or are growing them very fast, i.e. you're over here, and you'd call that kind of a quality or a growth approach to investing in equities, you're missing out on those companies that, yes, over here, they're not much crack, poor quality business, sure, but over here, they're incredibly cheap. And as I say, if all you invest in is a quality or growth style, you're going to miss out on those types of businesses. Now, I'm going to put my hands down because I'm getting tired, but you get the gist. The flip side is if you're only ever looking at these cheap companies over here, and you'd call that a value style of investing, we're here in South Africa, you guys are very familiar with that. That's your likes of Alan Gray, value investors. But if you're doing that, you're only willing to invest in things that are optically cheap, they've got a low PE, a low price to book, these kind of ratios, then you're maybe missing out on the businesses over here that, sure, they're expensive, but by gosh, they're worth it. And that might be an Nvidia of the world or other similar type, very high quality business. Final thing I'd highlight is there's also the question of size. Successful managers, they build AUM, all of a sudden they can't invest in smaller type companies. So why do you need a bigger roster of managers? Well, we want some managers that are dedicated to smaller companies. That, of course, is the pipeline of new success stories. Even Nvidia was a small company once, remember? So alongside our large cap managers, we want small cap managers as well. Final thing I'd highlight is also we want to be able to express a view on regions. To do that, you're going to need another dedicated manager. And I already mentioned Maura Wright, that's our dedicated Japan manager. So for those reasons, you want a big roster of managers and hopefully managers that are novel to this audience because we've been around the world to find them.
This slide shows you the total investment charge once you've combined all the underlying managers in the portfolios. Then you take our 25 basis points DFM fee that you add on to that. So including all the underlying managers plus our DFM fee, you'll see that the range is between 88 and 96 basis points, making these portfolios extremely competitive. They say the proof is in the pudding. And as I've already mentioned, these portfolios have a long track record. And as you can see from the slide, they have comfortably outperformed both the peers as well as the benchmarks over all measurement timeframes. And just to highlight, we haven't chosen an arbitrary peer group. This peer group here is the Morningstar peer group, which includes all the funds that are FSCA approved and available for retail investors in South Africa. Another bit of good news is that we have successfully negotiated preferential platform fees for all of our clients on both the Momentum Wealth local and Momentum Wealth international platforms, whereby clients accessing these models get a further 10 basis points reduction on the first tier of the platform fee. So in addition to getting really good preferential fees across the investment side, you also get additional preferential fees on the platform side. The offshore portfolio managers are in South Africa every quarter, and so our clients get access to the team of local and offshore managers regularly. But to make it easier for advisors, we also run quarterly CPD-accredited webinars covering the global and local economy, detailed market overviews, as well as detailed portfolio performance and attribution. Advisors also regularly get to see underlying managers and some thought leadership pieces in these webinars. For clients who meet the minimums to justify a bespoke offering, we also run quarterly in-person investment committees covering similar topics. In addition, all clients receive monthly fact sheets by the 10th working day after month end, as well as quarterly investment reports which are co-branded for bespoke and Category 2 clients. The advantage of having a team based offshore is that it opens the investment universe, but also our lenses as investment professionals. And to give you some insights into a topic we've recently been debating, here's Richard Stutley from the London team, one of the portfolio managers, to talk to us about what investment opportunities lie in the fixed income space. Richard, over to you.
Well, okay, they were a return-free risk, let's say, when 10-year yields were at 0.5%. Rewind, that's in the depths of the pandemic. Today, they're clearly better value with yields at over 4%. Now, I think where this question comes from, there is, today a lot of focus on the US budget deficit, debt to GDP, these kind of things. I'll quickly address that, and then I want to move on to some other things. I think the US can manage its debt. That said, there is absolutely no question that its worthiness has deteriorated. So things are okay today. Is it a worse credit today than it was 15 years ago? Absolutely. Look at the trajectory of said debt. So that's kind of to directly answer your question. What I want to stress, though, is that bond investing is about a lot more than treasuries, okay? If you don't like the US as a credit because you're looking at it and you're going debt to GDP, it's now in excess of 100%, fine. We'll go to another government, say Germany, where debt to GDP is more like 60%. So therein, the first solution, look around the world at similar type credits and pick your favorite ones. That's the first thing. And here we're still talking about government bonds. Again, the bond market is so much bigger. Most of what we own, in fact, is corporate debt. So bonds issued by companies. Now, what is that? That's a different type of claim on exactly the same companies that you own shares in. So my question to you, if you're a bit turned off by bonds, is why are you giving up nigh on 50% of your opportunity in exactly the same company? Microsoft, the shares, as I personally think, may be expensive today. That doesn't mean the bonds necessarily are. So maybe I get access to exactly the same company, but through a different instrument, i.e. the bonds. As I say, take Microsoft, take any of these other blue chip companies. Why am I only looking at the shares they're issuing and why not the debt? So just to round this off, treasuries, very topical at the moment. I think they're okay, but more so, forget about treasuries. There is a huge amount more when it comes to bond investing, and that's precisely why we did it.
Thank you for your time. We realize that you have the choice of somewhere else that you could be, and we appreciate you've chosen to take the time out of your busy schedules to listen to us. I'm always happy to take questions, so my team, myself, as well as members of the Momentum Investment Consulting team are available should you have any further questions.